So before I get into this video, I already explained a lot in here. You guys can see the title, but I am creating this account for you guys. I'm going to be adding my insight and my research, but let's source that information. So at the end of the video, if you make it as far to see the first plays I want to do, this is why we made this portfolio. I'm going to be, we have this $500. I'm going to be adding my own money to it monthly. I have my play ideas for the first ones I want to buy, but I want you guys to decide. So comment below which should be the first stock purchase out of the ones I do, and I'm going to pretty much go through the comments. Whichever stock has the most votes, that will be our first purchase that I will be making Monday or sometime throughout this next week. All right, ladies and gentlemen, hope you're having a wonderful weekend. Today, we're going to talk about long-term investing, and I know the title is a little bit extreme, but you could call it clickbait, you could call it whatever you want, but we fully plan on doing this because all it's going to do is take a little bit of time, and this is what I've talked about in the past, so you guys are going to have the opportunity to watch this YouTube channel grow alongside of a long-term portfolio, and I've been saying this, we've been preaching it a lot. Start a long-term investing portfolio, do this, do that, and I say, the best time to plant a tree was 20 years ago. The second best time is to plant one right here, right now. So that's what we're going to do. I created a portfolio, and all these free commissions, it's made us have a lot of good outlets now. So I put $500 in here. Why I say $200 in the title, because that's what I'm going to be putting every single month. So I have a plan outlined for you guys. Well, essentially for myself, and this is what I'm going to do. And you guys could use this to fill in the blanks, do whatever you need with your lifestyle and investing, and go from there. So I'm going to talk about what I want to do, and then I have the stocks that I'm going to be looking at in the first ones I'm going to make. So if you guys are tuned in live, you're going to watch me be able to make these trades. You guys will see. I'll keep you guys updated on this, and we're going to tune in on this maybe every month, every quarter, but it's not going to be anything too crazy. But I do want to show you guys the power of time. I know it may sound a little bit crazy as far as the amounts go, but this is something I've done in the past. But a lot of you would be surprised what you could do with long-term investing, and even with small amounts of money. It's not about putting in large amounts, and even then, even if we are starting with a smaller amount here, I'm trying to show the power of long-term investing, dividend stocks, all of that, even growth stocks, but with the effects of a large amount of time, if you guys have seen what we've done live and what we've talked about with it. So you could start with a bigger amount, you could start with the smaller amount, as long as you just start and take advantage of the opportunities here. So let's get straight into it. Make sure you guys drop your thumbs up on the video. Make sure you guys are subscribed. Make sure you check us out. We are live Monday through Friday, 30 minutes before open, and check out some of the other videos on the channel with options trading. I have another long-term investing video and all that, but also to understand that this is a recommendation for financial advice. Option trading is extremely risky. You can lose all time with your financial investment. Please consult with a financial professional. I'm just showing you guys what I'm going to do. You guys are going to be able to watch this and see how it goes over time. So you could even use me as a place marker to get better entries, maybe worse entries, get inspired, and that is the whole point of this. I really want you guys to get inspired for long-term investing. So I know a lot of people want to make a lot of money, and even with that title, I mean, you would be surprised what you could have done in the last 5 years. I've even had instances myself being able to take advantage of stuff, and I really think that as we're going through this political climate, we're going through a lot of stuff in the market, it's going to create some awesome opportunities, and there already is some. So I can't even wait to show you guys the stocks that I got lined up for us. So let's get straight into it. So right off the bat, the first thing you got to focus on here and, setting up the long-term portfolio, and what we're going to be doing is deciding our monthly allocation. So I have $500 in here, but what I plan on doing is going to put $200 a month, and we're starting with an initial amount of $500. Now, that's the key with all this, is that you could do the minimum here, but minimum may not always be the best. It's, the key here is compounding interest. It's what happens after 5, 10, 15 years, but you could start with the bigger amount. That's even better. And this is really the whole point. I'm treating this like a savings account. And that's the whole idea, is I want you guys even to get in the habit of saving money. So some people, you have a lot of money even saved up over years. That's awesome. And all the same principles here apply. But you also have to make sure, a lot of people say, don't invest what you're not willing to lose. It applies here, but it's different than trading. This is along the lines now of, we're putting this money in and we're locking it away. Warren Buffett philosophy: invest in stuff as if you couldn't sell it for 10 years from now. So the minute it goes in, you got to forget about it. I even tell people, hide the money from yourself. That's something I've even done a lot of times in the past with different assets. Bitcoin, when I first bought it, even my long-term stocks, I just act like I don't have this money. So if you saved up $5,000 or $50,000 and that money, you need it, you're going to have a liquidity need or whatever, don't put all of that money in. You got to set a reasonable amount of how much you're going to allocate, and that it's going to be monthly. And then again, knowing yourself, don't start with too small amount. make sure you're getting in something that's going to be at least worthwhile to you to let it go. But the key is how much it goes over time. But essentially, this is going to be a savings account. This is all we're looking at is how do we put ourselves tied up in a longer term investment that's going to be able to yield more than a savings account, essentially. So it's how you allocate monthly and deciding that amount. And then the next thing is allocation of stocks. How are you going to divide the money up? Which sectors, I put weighting, I meant weighting. Which sectors and which weighting you're going to be doing. And in terms of this means now, once you have the money in the account, how are we going to divide the money up? What are we going to put them into? Here are the different sectors that exist. You got basic materials, capital goods, conglomerates, consumer cyclical, consumer non-cyclical, energy, financial, healthcare services, tech, transportation, utilities. Now, this is an important topic because a lot of people, you're probably on YouTube, you probably think you have to do a lot of financial investigation to pick the best stocks. And well, think about this. If this is going to be your savings account, it's not going to hurt you, but at the same time, don't ever miss first part of investing is invest in stuff that you use or that you know is going to be here in 10 years. That's the thing. I have another long-term investing. You guys should go look it up, but the key is don't listen to anybody. Don't listen to me. To a certain degree, you don't need any crazy fundamental analysis beyond the fact, will it sustain and will this product or company or service be around here in 10 years? Will it be able to survive the test of time? And you need to have some level of belief. That's all Warren Buffett did when he was starting out with stuff. But that's usually one of the best rules of thumbs that I decide with weighting. So now when we're going to be selecting the stocks, the first purchase I'm going to be making, I'm going to be going after tech and growth. So stocks that could grow more for me. And again, this is how do you allocate your stocks? Are you going to put it into stuff that is safer, that is going to be producing a yield, like dividend stocks that are going to hold its value? Do you want it to grow and be volatile? And each of these has these advantages and disadvantages. And that's what we're going to be covering as I get into the stocks I'm going to be buying. And as you guys see this account over time. So what is my goal here is taking a small amount of money and again, a consistently small amount of money and growing that to a large sum. So in a sense, I'm going to be weighting it in and putting it, essentially, I'll probably be 50% growth and high growth. Again, I'm younger too, and we have a lot of time to do this. And that's usually a rule of thumb. The older you are, the more preservation you have for your money, the lack of ability you have to generate capital and money. Again, it's easier. You guys who are younger, you guys are 17, 20, you could lose everything and get right back into it. You have the ability to make money. It's going to be a little hard for somebody who's maybe 40, 50, or 60. But then again, at the same time, though, just because you might be on the older end, it doesn't mean you have to only go into safer stuff. You know your lifestyle better. That's why, we give these disclaimers. That's why we say consult with a financial professional or, do your own due diligence with it. But you don't want to risk too much. But for me, I'm going to be going with stuff that is going to be able to grow. I want 50% growth, and then I'm going to go with growth stability, essentially, in the sense of I want something that is more a dividend stock that pays a yield and that has a certain level of stability, but I also want it to have a growth element. And that's what we're going to be starting with some of the first purchases in this account. And these are going to be stocks that have high dividend yields, but also the high potential to grow. And you guys will see as we get to that. But moving forward, I'm just going to be using $200 a month for stocks. And guess what? You saw that last video with the options, with all these strategies with options, spreads, and this. I'm not leaving out trading. So I'm still using $100 a month for options. Again, we haven't had the need to as the options account growed. And this is how you could use these accounts simultaneously if I really, really wanted to right now. And again, this has to do with your strategy, right? I could take some of that money, or if not all of that money from the Robinhood account that, again, we turned that thing $100 into $1,000 with the trading. I could go withdraw that money, start back at an initial $100 a month and still keep doing that, and then take that profit I've already got and go stick it into this long-term portfolio. So that's up to you to decide. Maybe I'll let you guys vote on this too. So comment what you guys want me to do below. Should I say switch profits from Robinhood and put it into the long term, or keep trading and keep them separate? And again, maybe we'll do it, but again, you guys get to vote on this. So that's an option we could do. But at the end of the day, when you put all this into context, realistically, I'm going to be doing $300 a month between a long-term portfolio and options. And look at the allocation. Out of this whole $300 a month, 30% is going into a high risk, high yield strategy like options, and then 60% is going into safe. So hopefully you could see how this is being allocated. But at the end of the day, this is just $3,600 a year. Now, for some people, I get that might be a lot, and this is where I want to start with an amount that is realistic here, because this is the whole point of why I'm doing this on YouTube for you guys and why I want you to see, because before you know it, you guys are going to see what you could do if you literally just had the ability to make $36,000 a year. $3,600 is only 10%. So it doesn't matter how much you start with. It matters when you start. So again, too, whether you're using a lot more money than that or a lot less, you could replicate and do something similar. You could be using, if you make half of this amount, you could do the same thing and just take 10% and allocate it every month and divide it. You could do 60-30 here if you'd like to, with options and stocks, and then go from there. But as far as now stock picking, I want diversification, but not too much. I want a lot of time, and that is the key with all this. You need a lot of time, and then again, in the early years, when I look at my first long-term portfolio with my Facebook stock, my Google and Amazon and everything else I was able to acquire, the key was that I wasn't very diversified. I didn't put, as I was making more money and put my sum into stocks, I didn't, thank God, I didn't have stuff into too much dividend stocks or stocks that held their value. I was putting my stuff primarily in growth. And that's kind of the key with this, is that the first 5 years, really, you want to be placing it and weighting it heavily in one direction so that you could make more money or expose yourself to more risk. And again, this is what I wanted. This is where you're going to have to decide what you want. But the key is, you don't want to be too diversified. Diversification is good, but when it comes down to being able to turn small amounts of money or even a larger amount of money and give yourself some of that upside of the stock market that a lot of people desire, too much diversification isn't going to be good. Now, if you want stability, you go for a lot of diversification. That again, it's like comparing buying a certain stock versus buying an ETF. One is less diversified, one is more diversified. One will offer you more gains and losses, one will offer you less gains and losses. But the key is that we do need a lot of time, and this is the point with that, is that you could be positioned less diversified the first 5 years, and then as more time goes on, more success from certain stocks, then you could divest into other assets and then start balancing it as the accounts grow. Initially, you don't want to divest too quick, and you don't want to you don't want to be spread too thin initially. So there's that. And again, too, this is here. It's very, very simple as far as setting up this long-term portfolio. Pick your brokerage. I like TD Ameritrade here now with this. Again, now that there's free commissions for the long-term portfolio, I would go with a Thinkorswim, a TD Ameritrade, a E-Trade, a Charles Schwab. Pretty much anybody who could automatically reallocate your investments for you if you have dividend stocks or anything like that. So it's free commissions now. This is light work. I'm going to be going with them. And then pick your plan. Think Goldilocks. What do you want? Too hot, too cold, just right. You have to be able to decide with this stock picking plan, the allocations, everything. You really just have to focus on what you want out of it. And we've talked about this. Go listen to some of the 11 at 11s. The key here is the goals that you're starting with, and then go from there. And once you have your plan, it's just about executing. You're either going to buy indiscriminately on auto, and indiscriminately, that means just on the first day of this month, the 15th day of this month, right when I get the money, I'm just going to buy. I have my stocks outlined. Or you could buy in a window. You could set yourself a window. And again, let me know what you guys want to do. I'm leaning more towards a window, or even then indiscriminately if the cash sits too small. You don't want to be focusing too much. The farmer who waits for the perfect weather never plants. But as I go over some of these stocks, I will share, there is an industry, healthcare, which I think we could have a better window, but that's going to be as far as, diversifying at the later end. But that's what you have to decide. You either, and again, I'm going to put the $100 a month right away, right when the money hits there, or we'll wait every quarter or two to buy. That's another strategy you could encompass. So keep that in mind. But essentially here now, as I'm going through this portfolio, this is my plan that I think we're going to be using on this, is that I'm initially going to be starting out maximizing the allocations, not keeping too much cash. So a lot of people ask, how much cash should you keep? You should keep cash so you could buy stuff. But here, again, I'm younger on this. This is the first day of the portfolio. I mean, I'm treating this money as very safe. I'm treating this money as money that, I'm ready to lose in that sense, but I'm not ready to lose. It doesn't mean we're going to take too big of risk. But the whole point is I'm starting today. I'm kind of behind. It doesn't mean I'm going to gamble, but what I do want to do is start putting my cash to work. Even though there is headwinds and risks with the market, at the very least, we will be adding more cash coming in every month. So again, as things change, we'll be able to decide when to purchase or not, but I do want to start actually deploying this capital and getting it to work. I don't want it sitting here too long. And again, as the account starts growing, that's when we're going to start divesting it there into cash. It's not saying, you know, I want to maximize the allocation. It's how much cash should we keep if we want to buy something for dry powder to buy the dip. As I start adding to it month by month by month, and we see what the stocks are doing, then we'll go from there and do that. And then last, I know some people have asked about this. It's not about the amount of shares. It's about the amount of money. A 5% yield, the stock goes up 5%, it pays out 5%. It's based on how much you put in, nothing relative towards the amount of shares. So you could only get one share, but it pays 5% and the stock goes up 10%. You still made 15%, even if that was a really expensive stock. So go with it. That's why I haven't looked into it. I'll need to check into like M1 and all that, but I just like it, you know, buying the shares, buying the equity, the OG way, how I've done it, making sure I get my little slice of the pie. The key here is just all about, you know, this is like, it's like a savings account. It has nothing to do with the amount of shares. It's how much money is invested and how much is the return we're going to be getting. And now, since we're doing multiple stocks, it's a blended return. So that's pretty much it. Let's get into the stocks now. So here are the stocks that I want to buy. These are my first 5 picks now. Some of these you've heard me talk about, some of you haven't. And this was after kind of making this plan here and kind of talking about and deciding what I wanted to. This is where I came to the decision. So we're going to put all these, but Snapchat, Spotify, IRM, MO, AT&T, and then this is what I was saying earlier. I want a high-yielding healthcare stock, but I'm waiting because I think healthcare is going through some changes. And again, with both the politics and the election, I want to see, but I want something that has a dividend and that's been beaten down with healthcare. But you'll see these two pretty much are technology and growth. This one is a REIT. This one is a consumer non-cyclical product. And then this is telecom. You could even say with a little bit of technology, and then here is high-yielding healthcare. But even off the bat with 3 of these, you know, this is set up. This is income, dividend, and yield. This is consumer cyclical with yield. And then this is another high yield. All of these, and again, all of these are high-yielding, and, you know, how they're diversified is their industry. But you'll see 3 different industries here, and then these 2 are pretty much the same. But I will be about just under 50% weighted towards tech, and I will add Redfin to that list as well too, but I already have some in that other portfolio. But I want to see, I mean, another one I would consider here would be Cloudflare, but it IPO'd too soon for me. I mean, that one's going to come up, and that's the key here. As time goes on, I'm going to be throwing out some more of these long-term picks as we start, but these are the ones I want to start with. So let's take a look, and let me show you now. Let's start with the first one, Snapchat. So this one, I like it for growth. This is just one I want to be able to buy into. And again, I need you guys to tell me which is the first vote that you want to put in. Which should be the first one we should put, or if you guys have, and again, we have $500. So if we really wanted to, there's 5 companies here. If we really wanted to start and keep it equal, we could just go put 100 into each of these right now and use that as our base $500, and then use the additional $200 a month to go from there with how we want to add. And that would be a pretty balanced and safe strategy. I'm not too opposed for that, but let me know what you guys want to do. But essentially, this one pays no dividends. The key is, you know, you can pretty much buy it half off from the highs. However, imagine, you know, this thing was trading at $6. That's kind of crazy to think about. So it's kind of right here in the middle. That's why the timing is going to be interesting. If anything, maybe if we did decide this, I'd wait till earnings. But this is something I just think they're going to be around. So this one's a high risk, high reward. But I do think as far as the tech goes, the user base, all that, in 10 years, Snapchat's going to be able to, I think, is going to be able to grow and will be around here. And if they're able to execute and take advantage of their user base and things change in the marketplace and they get some more of a positive shift or take up some of that social media market share, they could be pretty good. So that's why I like them. That one's a solid one. The next one is Spotify. So this one, we would only be able to buy 1 share, but here it's at the bottom range, and maybe we wait being an IPO and it comes down, but I love Spotify in general. I think Spotify will be around, or I think they will get acquired by an Apple Music, who will be their competition. But I really like it because people use it. The younger generation uses it. The older generation uses it. And I think they will be here in 10 years simply because the value they give. It's intertwined with social media. People know about it. It's in cars. They just got it into the Tesla. And essentially, it's the value it gives value to the consumer. That's why, there's a reason they're going to use it. Even like Snapchat, there's a reason these kids are going to use it. I think people would really keep using it, and the artists too. Spotify is responsible for a lot of artists blowing up, coming out of nowhere, and it's made them millions of dollars and given them fame and celebrity. it's because of how the platform works and pretty much how awesome it is. So I think it's always I think it'll be around here for the next 10 years. And the fact is, I like how it's pretty much down so much here. So we'll see after earnings. Again, that could be one, but I really like them. And these are my tech stocks here. The other ones, like I said, Redfin and Cloudflare. But for the most part, I know Redfin will be there, and I already have literally. I bought that for my nephew. I allocated a lot of money to that one already. I think we have like 30,000 into that already. I think maybe, I mean, give or take a little more. I need to double check on that. But so again, I don't know if I should put it in here. But again, if we want to treat this totally, and that's kind of the point, I do want to treat this independent from everything, but just throwing out some ideas. But these are the ones I've came down to. And then next, we're going to take a different route. And I know I really don't like these companies. I don't like them, but hopefully you see how it meets my philosophy of what I'm trying to accomplish now. So you see how risky, and look at the charts on Spotify and Snapchat. They're all over the place. Now look at the 10-year chart here. This is Iron Mountain Inc. This is a REIT. So this is going to be a high dividend payer. But now how the equity works is interesting. But Iron Mountain is real estate. It's protection real estate. That's pretty much there to store data, store services. Even they store Bitcoin, anything pretty much important. So you guys, I'm sure some people know what Iron Mountain is, or you've heard about it. But I like them because I think that model will be there. But beyond, do I think it'll exist? Yes, for sure. I think it's going to be there. But what I do like is the stability. So even over like 20 years, it's really not that crazy. Even from 2008, it's almost at the same price. So that's kind of the key with this, is that it might slowly start going up, and we could kind of get it here towards literally the middle range, somewhat lower. But the key that I like about it, it pays a really, really high dividend. So if we are able, and this is where I'm saying the advantage of getting some with a smaller account here too, and long term, these are the dividend stocks I want, where we're able to buy them at, we're buying it at a multi-year low. So if you're able to catch a 7% yield now, and then the equity starts going up in that, and we're able to get another $10 per share and could go up 30% on the investment while catching 7-8%. That one's pretty good. But this is a high risk, again, a high yield, but I like it. I'm really into that one. But then another one on the same aspect that I really, really like is Altria. So I think tobacco is going to be here. They have a stake in Juul. They did cancel the merger with Philip Morris, which was, again, some could take that as a bullish sign. If the markets do start coming down, I mean, I don't think people are going to stop buying cigarettes. And if things got bad, people always say that old adage, oh, yeah, well, people will drink more and smoke more when the economy's not good. Either way, I think they're going to be here for a long time. I think they're going to at least be here for another 10 years. Or in general, as the nicotine world changes and these addictive supplements, they're going to find a way to get their sticky fingers in the cookie jar, as they have been with even like Juul. So I like them. And again, if you really think about it, with the health conscious movement and all this negative stuff, they've been getting killed. So again, this is one where we're able to get it literally half off from where it was a few years ago. It's at these 2013 levels. Again, it's going to have a little bit of base support. Maybe we could lose another 30% on the equity, but it's paying out 7.8%. High yield. It has upside and even some stability in any sort of kind of market environment. I like those two to both start out that, along with IRM, to kind of both paying out 7-8% to kind of with a little bit of upside and growth. They could hold it down. And then again, even if add that over the years, regardless of what the equity does, if you're collecting that high dividend 5-10 years later, you'll see what happens. I mean, but you can see over the long term, though, they have been you're kind of still getting there at a high price, but that's just the nature of the timing. And then lastly, AT&T. Same logic. Even then, they're a lot cheaper than where they were 20 years ago. But even on the last 10 years, this is what sucks, because and now you guys can see, this is the whole mentality I've talked about with some of these plays, where if it's a dividend stock that is going to be here, like AT&T, it was at these multi-year lows, and then it's gone up. You would have almost doubled your money there while collecting a high yield, but the dividend's still high, 5.5%, and I think it has a little bit growth in it because of the tech and the 5G alongside with it, but I think it's pretty decent. So those are the ones I want to do. I think I'm going to be starting to add to this next week. Vote on which one you guys want. And if you have questions, please post them below. And understand, too, this is going to be the first video. So let me know when you guys want updates. You'll be able to see the updates live every day. We're streaming live and you'll get to see it. But we'll give you guys some updates and changes and when I have ideas with it. But let me know. And if you guys are going to start this along with me, I'm excited. But at the very least, hopefully this inspires you guys and you guys get to see it. And again, it's going to happen slowly. But I promise over time, we're going to look back at this and we'll be amazed at what we could do. And again, as new companies come out and as new opportunities present themselves, we're going to use this to capitalize with it. And you guys, just start saving your money. I mean, at the very least, this is a cool way to save money, get your money saved, and expose yourself to opportunities that will be amazing. So that is pretty much it. Make sure you guys drop your thumbs up on the video, drop your vote on what we should do. Go watch the other videos, show some love, and get ready for the watch list tomorrow, baby. Let's go.